Hi, my name is Sam Kilally. I'm the founder of YourFD. We are accountants that understand, measure and grow our clients. This video I want to talk about cash drivers. Drivers that will have an impact upon your cash flow and your bank balance. A driver is basically a habit or an action that, if implemented and measured on a consistent basis, will have a profound effect upon the metric or measurement you're trying to improve. In this case, cash flow and your bank balance. None of these drivers are anything complicated. There's nothing new in what I'm about to say. The actual secret to all of this is getting this done on a consistent basis. Driver number one is probably the most common one, and that's debtor days, the time taken for your customers to pay. I always encourage clients to implement and carry out a consistent credit control system. Clients, businesses in general, should never feel shy of asking or expecting their customers to pay on time every time. The second driver that I would like to share with you, and this is quite a driver that quite often gets missed, and that's the time taken for you to send your sales invoice out. So all well and good trying to get the customer to pay quicker, but if you're taking a while for your sales invoice to be raised and to be sent, then you're certainly missing a trick. I had a client of mine that had a sales invoice on average would take around about a month in which to be sent out. We've kind of seen that, we've kind of realized that, and now that's been reduced to around about 7 days. So what we've been able to do is reduce the time taken for his customer to pay by using his own actions. And that's something that a lot of businesses will miss. The third driver that I want to mention is the working capital cycle. And this is aimed at businesses that manufacture or make a certain product. A measurement should be put in place to look at the time taken between when the order is raised and when that certain product has been manufactured. The less time that takes, the speedier your invoice can go out, the quicker that you can get paid. The fourth and final driver is stock, and it's the amount of stock a certain business will hold, and it's a really important driver to get right. Too much stock could mean cash tied up in your business. It could also mean slow moving stock, which could potentially be valued at less than the cost price. Too little stock, on the other hand, could mean you don't have enough stock to meet demand, and your customers could go elsewhere and never return back. And that's always a possibility when you carry too little stock. So getting the right stock balance is certainly a massive thing to get right, and it's a massive thing to get right for cash flow reasons. All these drivers can have a massive impact upon your own bank balance and cash flow. Although they can be quite difficult to measure and implement, I would certainly encourage you speaking to your own accountants to try and get these implemented with your own business. Get these right, and they will certainly have a massive impact on cash flow and bank balance. For now, that's Sam, YourFD. We are accountants that understand, measure and grow our clients. Thank you.